This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to another deep dive from AJ Bell Money and Markets. Believe it or not, it's 3 years since the disastrous mini-budget when Liz Truss's first Chancellor, Kwarteng, announced a set of economic policies which sent the UK bond market into meltdown. We thought 3 years later it would be an opportune moment to delve into the world of bonds to see how the market looks right now and ask why bond yields have been dominating headlines. Once again, we'll be looking into the nitty-gritty of bonds, but we've also got a couple of great guests to talk us through the big picture as well. And joining me on this foray into fixed interest is Danni Hewson. Danni, hi.
Hi, Laith. Yes, if you have read any of the financial press recently, you'll no doubt have heard that long-dated 30-year UK bond yields have hit a 27-year high. Though they have backed off slightly from where they were at the start of September, they are still higher than in the wake of that mini-budget Laith was just talking about. And that, of course, is adding pressure on the Chancellor to raise taxes at the budget later this year. In this deep dive into fixed income, we'll be taking a look at precisely what bonds are, how they work, and whether they are at risk from governments borrowing more and more money.
Yes, and we're going to be talking to Rupert Harrison from the asset manager PIMCO. In a former life, he was actually economic advisor and chief of staff to George Osborne when he was Chancellor. We're going to be asking him why the UK's borrowing costs are so high and what he thinks about the bond market and what it wants from Rachel Reeves in that forthcoming budget. We'll also be discussing Trump's attack on the US central bank and what that means for bonds as well. So do stay tuned to hear that interview.
We'll also be talking to Alex Ralph, fund manager of the Nedgroup Global Strategic Bond Fund, about how she picks bonds to invest in and where she's finding opportunities right now. But before we get there, we're pleased to be joined by Ian Aylward, Head of Investment Partnerships at AJ Bell. Ian, welcome to the pod.
Hi, Danni. Thanks for the invite.
Can we start by getting into the basics of bonds? Because we hear a lot about bond yields, especially in relation to government finances. But what are they and how do they relate to bond prices?
Sure. Thank you. So bonds are essentially a loan to the issuer of that bond. So let's take the government. Let's start with the government, but do be aware that companies can issue bonds too. So the government issues the bond. And in exchange for taking up these bonds, essentially lending the government some money, you get a rate of interest. Now, that rate of interest is called a coupon. You get that coupon in return for that loan. Now, this coupon payment is fixed, and the term of the loan, i.e. the life of that bond, is also fixed. So let's give it a hypothetical example. The government may issue £100 worth of bonds with a coupon of, say, £5. Now, that £5 is paid each and every year for the next, say, 10 years, for a decade. Now, dividing that fixed coupon by the price, so that £5 by the £100, gives something called the yield. Now, really importantly, the coupon is not the same as the yield because, really importantly, to make this point early in this conversation, that while the coupon is fixed, the price of the bond is not. So the price of the bond can fluctuate through time. It is fixed at the end of its life, so you do get the £100 back at the end of the life of the bond, but the price can move through time. So it's a fact, then, that as the price rises, so the yield falls, and as the price falls, so the yield rises. Let me give an example. So if the price was to rise to, say, £110, that fixed coupon remains £5, but the yield falls to 4.5%. The good news is that whilst you may get gyrations in that price over the years, as long as you hold the bond to maturity to the end of that decade, you do get your £100 back at the end. And by the way, the end date is known as the maturity date.
think that is often a source of huge confusion, that yields and prices move in opposite directions. So thanks for the clarity there. It often feels that when people are talking about the bond market, they're talking only about government bonds. And you said earlier that companies also put out bonds because it is only one part of the market. So just go through the main types of bonds out there and how they interact.
Sure. So we've spoken about government bonds already, and just to reiterate that again, Danni, this is when you are lending to the government, and sometimes these are also called sovereign bonds. So they're the same thing: government bonds, sovereign bonds. Now, the risk with government bonds is that the government cannot afford to pay you back that coupon, the £5, at some stage in the future, or indeed that you don't get the £100, and that's called the notional, by the way, back at the end. Now, the good news is the UK government has never defaulted. It's never failed to pay back the coupons or the notional in many centuries of issuing bonds. And indeed, neither has the US, for that matter. That is why the yield on such bonds is often called the risk-free rate, and why all types of bonds tend to be priced relative to that government risk-free rate. There is some bad news, though. Sometimes default can happen. So by that, I mean that in certain countries, the government can fail to give you your money back. I mean, typically this happens in smaller countries with stretched public finances, poorer areas of the world like Africa or South America. And these parts of the world with this elevated risk, we call this emerging market debt or emerging market bonds. As you might imagine, the listeners might imagine that coupons are actually much higher in these regions because people want to be compensated for that higher potential risk of default. Now, as you said, and we both said earlier, it's not just governments that issue bonds. Companies issue bonds too. And these company bonds tend to be split into two buckets, depending on how likely they are to default. So the first bucket is called investment grade debt, and these are issued by blue chip issuers, well-known names, the likes of Tesco and Shell, and that's where the risk of default is really, really very low. As a result, as you'd expect, then those types of bonds pay low coupons. The other bucket, the other category is high yield bonds. They're also known as sub-investment grade bonds. And they are issued by firms that have a higher risk of not paying the coupons or indeed the notional. And so these pay higher coupons. And actually, that does sometimes happen, that those companies do fail to pay back the coupons or the notional. Names you might have heard of include TalkTalk, the telecom company in this country, or Wilco, a name that was on the high street until recently. These firms have failed to pay, and they have had to go through a financial restructuring accordingly. And so, as you can see, as always in investments, the more reward you wish to seek, the more risk you have to take on. Now, I think an interesting point, is that a corporate bond can actually have a lower yield than the government bond in the same country. So if you think about that for a moment, you're saying that investors believe that a company can be in better financial shape than the government. So this actually can and does happen. And an example would be Microsoft in the US, for example. There are some other types of bonds just worth mentioning, touching on in case you come across these. So inflation-linked bonds are common and actually really quite important, and not just issued by governments. So what I mean by inflation-linked bonds is that in this instance, the coupons and the notional amounts actually rise with inflation. Now, if you think about that, that makes a lot of sense, actually, because going back to our example, let's use the example. If you get the £100 back at the end of the decade, the end of that 10 years, but there's been a strong period of inflation over that period, that £100 may be worth a lot less, actually, in real sort of purchasing power terms than it was. So by investing in inflation-linked bonds, it guards against that risk because the coupons and the notional value, that £100 at the end, actually rise with inflation. And also, incidentally, it does incentivize the government to keep inflation under control. The final one I mention are supranational bonds. You hear this quite often. They're simply bonds issued by entities that are not quite the government. So by that I mean things created by governments such as the World Bank or the European Investment Bank. And these are certainly, as you'd expect, typically very high quality and so have low coupons. There are a few other bonds and types of bonds I could talk about, but let's stop there. You do not need me here to talk about green bonds, blue bonds, etc., etc. Maybe that's a different podcast, but let's pause that there for now.
I think that's given us a really good flavour of the diverse range of bonds available to investors. Laith, before we move on, some people might have heard government bonds talked about using different names like gilts and treasuries.
Yeah, that's right. So, I mean, different government bond markets will have different names. So, treasuries tends to be what we call the US market bonds, and gilts are essentially UK government bonds. So, depending where in the world you are, the government bond market is almost certainly called something different to other regions, which I know doesn't help with matters, but it's all part of the rich tapestry of the bond world.
And I love the history of the fact that the UK gilts are called gilts because they used to be issued on paper and they had the gilt edging, which...
Is that right? I did not know that,
Yes.
Danny. Yeah,
There you
interesting
go.
facts. Yeah.
Bit of history for you. Look, can you just give us a quick overview of the types of things that make bond prices move up and down?
Yeah, sure. Well, I think first of all to say it's very important what Ian just brought out there, which is that if you hold the bond to maturity, you get the money, the notional value back. But what happens in the meantime is that market prices are basically moving around. So if you want to sell before that point or buy, then that market price is going to determine what you get. And there are various factors that are going to feed into that. A big one is interest rates, or rather, to be more specific, interest rate expectations. So those conventional bonds, as Ian was saying, they pay a fixed income. So let's say interest rate expectations go up, then that's going to mean that fixed income doesn't look that attractive anymore, and so the price of that bond is going to fall. Until such time as the yield is more in line with interest rates. So interest rates going up, or interest rates expectations going up, generally means bond prices falling and yields rising. And longer dated bonds are, other things being equal, more sensitive to interest rate changes because those changes effectively have longer to play out. The technical term for that is that they have a higher duration, for what it's worth. So interest rates are a really big factor. Inflation, again, a similarly big impact on bonds. I mean, inflation really is the nemesis of bonds when you think about it. Bonds pay a fixed income stream, and inflation basically just erodes that. So rising inflation basically takes away from the value of those income payments and also the value of your capital repayment at the end. And the other thing, Danny, is that that rising inflation, what does that mean for interest rates? Well, it normally means interest rates are going up because the Bank of England or the US Fed is raising interest rates rather to compensate. So it's a bit of a double whammy. We saw that in 2022. After the Russian invasion of Ukraine, we saw inflation picking up. We saw the Bank of England and other central banks raising interest rates. Some UK government bonds fell by 40% or more, which was very unusual for the bond market, partly because of where we were before that. Interest rates were at unbelievably historic lows. And we went to kind of what is a more normal environment of yields of around 4 to 5%. But that maybe gives you some indication of the impact that the interest rates and inflation can have on bond prices. So those are two very key factors, I think. We've also got the risk of default. Again, Ian mentioned this. This is important. That means the company or the government, the risk they're not going to pay the capital or the coupons back. We have credit rating agencies, which people may have heard of, people like Standard & Poor's and Moody's, and they assess that risk for companies and governments. They produce a credit rating for those entities, and that also is a risk and perhaps a factor in how much return you can get from a bond. As Ian said, the higher the risk, the greater the reward that you could get. And the other thing to bear in mind is that bonds often are seen as a safe haven. So if there is not very much risk appetite out there in the market, if there's what's called a flight to safety, people don't want to hold shares or anything risky because maybe there's a global economic downturn, then what they'll do is they'll perhaps turn to gold. But another safe haven tends to be government bonds because they're seen as relatively low risk, if not zero risk, in terms of getting your money back. And finally, the thing I'd say, Danny, that matters is supply as well, and this is particularly relevant at the moment. Bond supply, if governments are pumping loads of bonds out because they're borrowing lots of money, that means you've got a lot of supply, you need a lot of demand to soak that up. Historically, we have had a lot of demand in this country, in the UK, from the Bank of England and pension funds. But for various reasons, that actually may be waning. So important to think about the supply of bonds as well.
We've heard so much about bonds in the last few years. I mean, it's only really in the last couple of years when people have been asking me about bonds. Before that, they weren't really discussed, but now they seem to be, in the papers almost every week. Why is the bond market so important?
Well, I think you're absolutely right. I think that Truss Kwarteng mini budget really put bonds on the radar and pushed them into the public consciousness, perhaps in a way that they hadn't been before. I think the basic reason bonds are so important is that the bond market determines the rate of interest that the government pays on its borrowings. And so by extension, that impacts on the government's ability to spend money on public services and also their need to bring in money through taxation. So from that perspective, the bond market affects us all in our daily lives to a much greater extent, I would say, than the stock market does. And as we've seen, it can even lead to change at the highest levels of politics. We saw that was, the fall of Liz Truss was largely down to what was going on in the bond market. And, as we've kind of mentioned so far, it's interesting that 3 years on from that Truss Kwarteng mini budget, long-term government borrowing costs now in the UK are actually higher than they were at the height of that crisis. And with a budget coming up in November, that's clearly raising questions which are being reported at the moment about how the Chancellor is going to cope with that, what it means for spending and what it means for our taxes as well. So I think this is probably a good time to bring on our first guest, Rupert Harrison. He's currently a senior advisor for the asset manager PIMCO, but previously he was an economic advisor and chief of staff to the former Chancellor, George Osborne. I caught up with him to hear what he had to say about the current state of the bond market. Rupert, thank you for being with us today. Let's start, if we may, in the wake of the 2022 mini budget. After Kwasi Kwarteng was sacked, Jeremy Hunt replaced him as Chancellor, and he actually drafted you in as part of his Economic Advisory Council, which was set up to lend some, at the time, much needed credibility to fiscal policy making. It's now 3 years since that bond meltdown in the wake of the Truss Kwarteng mini budget. So why are UK government bond yields now higher than they were at the height of that crisis? And also, why is there nowhere near the same kind of panic?
Yeah, thanks. I mean, 3 years ago, I'm getting some flashbacks. It does feel like quite a long time ago, but actually, as you say, it's kind of set the scene for a lot that has happened in British bond markets since then, and actually global bond markets. And so if you think back to the kind of immediate weeks after Jeremy Hunt was appointed and the government began the kind of U-turns on many of the policies that had concerned markets, he did manage to restore calm and credibility quite quickly to UK markets. But with the exception that actually for the UK government to borrow at those longer dated yields, so to borrow money for 30 years, we have actually been paying a bit of a premium compared to other countries like the US and Germany ever since then. And that is partly because I think Britain's international reputation took a hit from that episode that will take a bit longer to mend in terms of our reputation for predictability and credibility. And I think markets now treat the UK, look, it's still a core global bond market, but I think markets treat UK governments as sort of guilty until proven innocent on issues around predictability and fiscal credibility. And I think that has come up again recently. We've seen this government, since it took office, borrowing more, particularly in order to invest in capital investment. So that has definitely demanded more of bond markets. The government is selling more gilts even than it was before. And also more recently, we've seen a lot in the headlines after U-turns on some of the welfare savings, for example, that has led markets to question whether this government can deliver cuts to spending in particular. So that has made a lot of the headlines. But actually, your question about why are yields now higher than they were at the time of the mini budget, the answer to that is mainly not about the UK. It's mainly a global story, and that is that we've seen yields drifting up around the world. We've particularly seen those longer dated yields, so they're out at 30 years, governments borrowing for 30 years. Those yields, those interest rates have been rising a lot, particularly this year. And we've seen steeper curves. So that means that the cost of borrowing out at longer dated, like 30-year points, is much higher relative to the cost of borrowing for just 2 years or 5 years. And there's many reasons for that. Governments around the world are borrowing a lot more. It's not just the UK. So we've got very high and persistent deficits in the United States. But also perhaps less well understood, but I think maybe more important, there are a couple of countries that have been kind of anchors for the global bond market for a long time, and that's Japan and Germany. And Japan has had effectively no inflation for a long time and very, very low interest rates. And Germany has been the sort of fiscal poster child for a long time, like very low deficits, very low debt compared to other countries. And both of those things have now changed because inflation is now normalizing in Japan, finally. And Germany, in the face of the security threat from Russia and elsewhere, is now borrowing a lot more, particularly to spend on defense. And those two bond markets have now started, yields in those bond markets have started rising, and those underpin the whole of the global bond market. So really for the UK, we have been carried along mainly in that global story, even if we still pay a little bit of a premium at that 30-year point and have done ever since the mini budget.
Yeah, so it's not just that everyone hates us. There is a global story going on here, basically. But I mean, if you do look at those overseas comparisons, Rupert, I mean, our government's borrowing costs, they're greater than the US, which you might expect, but we're also significantly higher, over longer dated periods than France, which is going through political and economic turmoil, than Portugal, Italy, and Greece, which, not that long ago were getting bailed out as part of the Eurozone crisis. Why is that?
So the reason for that is that bond yields are determined by a lot of things other than the credibility of the government that is borrowing the money. And particularly all those bond markets you mentioned. So, if we compare the UK to the US or to France or Germany, we're borrowing in different currencies. And crucially, markets are looking at the outlook for inflation. So they're looking at the inflation outlook in the UK and comparing that to the US and France and Germany. And they're looking at the outlook for policy interest rates, so that the rates that the central banks are setting. And actually, one of the things that has been happening to the UK recently, particularly since the start of August, is that we are starting to look like a bit of an outlier on the inflation front. Inflation looks like it's a bit stickier and long lasting in the UK, particularly than Europe, where inflation is now back to the ECB's target. Whereas here, it's, we're going to have a data that could take inflation this autumn over 4%. So that is making markets think that interest rates will stay higher for longer in the UK. And it's important to bear in mind that it's these kinds of dynamics that drive most of the swings in bond markets. So for example, if you look in the US, the 10-year yield in particular in the US has come down a lot over the last couple of months. And that is absolutely not because markets are saying, well, the US looks like a safer borrower and it's behaving well and cutting its deficit, because none of that is happening at all. Actually, that's because markets see the US economy slowing down quite a lot. And there's been some quite negative news about unemployment and the pace of job creation in the US. And therefore, markets are pricing more interest rate cuts in the US. And that's been the main driver of why rates have been falling in the US, but not here in the UK.
Okay, can we stay with the US theme for a moment? Because the president, Donald Trump, has been attacking the independence of the US central bank. He's trying to get it to cut interest rates really sharply. Do you think bond investors should be worried about that? I mean, what you've just said about falling yields suggests that they're not too worried about that. Is the general view that there are enough checks and balances in that Federal Reserve system to stop Donald Trump exerting too much control over monetary policy?
Well, look, this is absolutely something in any country that bond investors will be very focused on. PIMCO, we're the biggest fixed income manager in the world. We are monitoring this extremely closely, as you'd expect. Now, just to take a step back, central bank independence really underpins all of these bond markets. And if markets start to think that central banks are going to set interest rates because of pressure from governments to keep rates low, rather than to keep inflation under control, then that is going to be reflected in, again, steeper curve. So that means particularly borrowing costs will go up for governments that are trying to borrow at 10 or 30 years, even if markets might believe that lower interest rates in the short term might keep those short-term borrowing costs anchored. So it's a big deal. This is something that has come up in the UK. We've definitely seen politicians, and we still see some politicians question the independence of the Bank of England. So this is not something that's entirely academic for us here in the UK. In the US, look, we are monitoring this very closely. I think the view at the moment, the PIMCO view at the moment, is that we think that the checks and balances in the US institutions for now should maintain the independence of the Federal Reserve. And that's particularly, for example, if you look at the US Senate and the makeup of the crucial Senate Banking Committee, that is the committee that has to approve any appointments that any president makes to the Federal Reserve. And any appointment that Donald Trump would seek to make would have to effectively get all of the Republican members of that committee to vote for them. They couldn't afford to lose a single vote. And there are some relatively independent-minded senators on that committee. So those are the kinds of checks that are in place and I think markets at the moment are placing quite a lot of weight on those checks and balances. It's definitely something, though, that we will keep a very close eye on, because the independence of the Federal Reserve and the market's perception of that independence is something that really is an anchor for markets all around the world.
Yeah, absolutely critical to the bond market, I think. And we've talked a lot there about the global influences on bond markets, and in particular our own UK bond market. Is there actually anything that our own Chancellor, Rachel Reeves, can really do to control UK borrowing costs? It sounds like there's so many extraneous influences. And, you were advising George Osborne when he was Chancellor. Can you maybe give us some insight into that interplay between fiscal policy, what the Chancellor does at the budget, and bond yields? So, how difficult is it to keep the bond market on side, and also how important is it?
Yeah, well, look, it's incredibly important. Let's start with that, because if you do lose trust in bond markets and start to lose control of interest rates in your bond market, then that has a big impact, not only on your interest costs, the amount of debt interest that we as taxpayers are paying, but it also ripples through to the whole economy. So it could push up mortgage rates, could push up the cost of borrowing for companies. We saw that, for example, in the Eurozone crisis. If you go back to 2012, 2013, that kind of instability is very damaging economically. So it's very important, is the starting point. I think, as you mentioned, I think an important place for chancellors to start is that they do have limited control over a lot of the factors that drive bond markets. And as chancellor, I think it's always important to keep reminding people of that we're a relatively small open economy. We are absolutely dependent on what's happening to growth and inflation and trade and all those kind of global factors. So Rachel Reeves certainly cannot control what interest rates in the markets are going to be when it comes to the budget this autumn. I think what she can do is maintain markets' belief that she is going to be responsible and credible. So if we go back to 2010, you mentioned, I was working for the Chancellor back then. Markets had raised quite a few question marks about the UK's ability to deal with a very large budget deficit. But the new government that came in, that coalition government, placed a lot of emphasis on credibility, dealing with the deficit. We set up the Independent Office for Budget Responsibility back then to kind of restore faith in independent forecasts and statistics in the UK. And that's the kind of thing that Rachel Reeves is also very focused on. So she, when you listen to Rachel Reeves, she talks a lot about her ironclad fiscal rules. And that is absolutely crucial that she continues to do that, because that is actually the key thing that is maintaining market confidence in the UK at the moment. We do have a relatively high deficit. Our debt to GDP is a lot higher than it used to be, particularly after the COVID pandemic and the energy shock after the Ukraine invasion, and so much money was spent dealing with those crises. So we're in a vulnerable situation, but the fiscal rules are absolutely crucial. And in fact, we saw how important they are if you go back a couple of months when Rachel Reeves, was caught on camera crying in the House of Commons. And of course, there was sort of political drama to that. But actually, markets reacted quite dramatically to that. We saw, 20 basis points, single day move in UK interest rates. And that's a very big move for that market. And the reason for that move was that markets were suddenly worried that Rachel Reeves was going to be replaced as Chancellor by someone else who would come in perhaps with a looser set of rules or less commitment to meeting the rules. And that just tells you that, those rules are important and markets depend on the communication from the Chancellor saying how important they are. So that's, I think, what she's going to be very focused on as she goes into the budget, and what she needs to continue to do is to send a signal that her policy is going to be predictable. She's going to stick to the rules. She'll take the difficult decisions that are necessary in order to keep meeting those rules. And the likelihood is, I think, that what the markets are expecting is that this budget, that's going to mean tax rises. So in the end, she's going to have to deliver on what markets want to see, which is doing what it takes to stick to the rules, keep bringing that deficit down.
Yeah, I think that's so interesting, and maybe an underappreciated point about the tightrope that she is walking, which is, many people will say, well, why don't we just borrow a bit more? We've got loads of borrowing anyway. Just having a few extra billion here and there, would it make that much difference? But actually, there's a cost to that in terms of the price that the market charges you, as you were saying there, for that extra borrowing. Maybe can we just turn our attention to the forthcoming budget? What do you think the bond market is looking for from Rachel Reeves? You said, obviously, the fiscal rules. It seems very unlikely that she will break those or move away from those, I think. Is there anything else that you think the bond market is looking for? And in particular, Rupert, I'd be actually really keen to hear your thoughts on the sustainability of the state pension triple lock. It was introduced by George Osborne when you were advising him. How much longer can we persist with that?
Yeah, absolutely. Well, looking ahead to the budget, I think you're right that we don't expect changes to the fiscal rules. I think that is now very well understood by the Treasury, and I think by Number 10 as well, that those are absolutely crucial, and that the UK otherwise would be quite vulnerable to volatile markets without that. So we fully expect that she will continue to meet those. I think that the market is looking for a number of, things that would build up to a credible package that I think would help settle nerves and allow the UK to continue borrowing at the rates that it does. I think the first is that the market is looking for kind of predictable savings. I think markets are always a little bit skeptical of plans from politicians that maybe are penciled in for 4 or 5 years in the future when that politician might no longer be around. I think markets are also a little bit nervous about new and untested taxes. We have a little bit of experience of that recently. So both Jeremy Hunt, the previous Chancellor, and Rachel Reeves, for example, have made changes to the non-domiciles regime, which is about people who declare that their domicile is not in the UK and therefore they didn't pay tax on their overseas income. So there were various changes made to that regime by Jeremy Hunt and Rachel Reeves, and there were forecasts made for how much money that would raise. And it now looks quite uncertain about whether that money will actually end up being raised, because maybe people are leaving the country instead of paying the tax. And so markets are looking for much more, I think, predictable savings. I think will be more credible. I think markets would find savings on the spending side very credible, particularly from the welfare budget. But given the experience of the last few months with the government not really being able to deliver even the 5 billion of savings it set out, I think expectations on that side are pretty low. It's worth noting, quite an interesting aspect of Keir Starmer's recent reshuffle, though, was putting Pat McFadden in as welfare secretary, who's regarded as a sort of Blairite reformer. I think that maybe, and some people in markets have sort of suspected that maybe that's put another attempt at welfare savings back on the agenda. So that'll be interesting to watch. But I think mainly the market's now expecting tax rises. I think, again, it will be much more reassured by kind of predictable tax rises rather than kind of new innovative taxes that haven't been tested. We may come on to some of the things we might expect, but we've certainly had a lot of briefings around capital taxation, so taxes on property and pensions, for example. So predictability is first. Second, this issue of headroom. A lot of the problems that the government has faced over the last year has been could be traced back to an initial decision to give herself a very small amount of headroom, just £10 billion, which sounds like a lot of money, but actually in the grand scheme of a £2 trillion budget, it's a very small amount of headroom against her fiscal rules. And that means that there's constant speculation about policy change, because it only means you have to have a small change in the forecast from the OBR to suddenly mean the Chancellor's in breach of their fiscal rules and they have to put up some tax to deal with it. So I think markets would like to see much more headroom established to kind of put the issue to bed. Means that there's much less speculation over the years ahead around changes in policy. And then finally on inflation, I mentioned that the UK is looking a bit sticky on inflation compared to other countries. I think that markets want to see that the government is not making the Bank of England's job harder. So some of the reason why we've had this sticky inflation can be traced back to government policies. So for example, regulated prices like utility bills have been going up. The employer national insurance rise has definitely been being passed through by quite a lot of companies in the form of higher prices. And that's been making the Bank of England job harder. So I think that markets are looking for the government to do these tax rises in a way that doesn't put up duties, doesn't put up inflation. And actually, interestingly, we've seen some speculation coming out of the government just recently that they could even look at cutting some of these taxes. So there's speculation that the Chancellor could look at cutting VAT on domestic fuel and heating. So that, I think, shows that the Treasury definitely have internalised this issue that they mustn't make the inflation problem worse. So those, I think, predictability, restoring a lot of headroom, and don't make the inflation problem worse. Those are probably the main things that markets looking for from the budget. You asked about the triple lock, which is obviously a key issue. I mean, I was in the room when this policy was agreed. It actually was a Liberal Democrat policy in their 2010 manifesto. And of course, that 2010 government was a coalition. And I was actually in those coalition negotiations in those early days, just before the government was formed. And we were going through the sort of economic policies of the two parties and seeing, well, what could be adopted, what might have to be dropped. And this triple lock policy, we weren't very familiar with. Each party had a senior civil servant allocated to them who could go away and sort of do analysis of various policy options. And we asked our senior Treasury officials, like, this triple lock, can you go away and bring us back a costing? How much is this going to cost? And he came back and said, well, the Treasury thinks it's going to be £50 million. Now, that is, in context, that is a very small amount of money in the government budget. And I think actually the estimate was probably zero, but they didn't want to give us a zero, so they plucked a number out of thin air. And the reason for that is that the triple lock only costs money in a year in which either inflation is higher than average earnings, or when either of those are below 2.5%, because that's the rule of the triple lock, is that the pension goes up by the higher of any of earnings growth, so wage growth, inflation, or 2.5%. And as the forecast stood at that point, that wasn't true in any of the 5 years in the forecast. So they said, well, no cost. Of course, in retrospect, that policy has ended up costing taxpayers more than £5 billion. So that estimate was out by a factor of over 100, which must go down as one of the worst forecasts of all time. But look, that policy has now become absolutely politically totemic. And it is very, very difficult for politicians to go into an election pledging to deal with it. I mean, a lot of economists would say, well, actually, it's quite easy to deal with this if you're sort of sitting at the sort of, at a desk, doing academic research. There are some pretty simple ways to deal with this. If you go back to the original spirit of the Adair-Turner reforms in the 2000s, which is what underpins our pension system, the idea was that you should link the pension long-term with earnings growth, so wage growth, so that pensioners share in the average increase in wages and earnings over time. And in return, raise the state pension age in line with longevity. So that's why we've got this state pension age that's rising 67, 68 and higher as life expectancy rises. And I think that people have put forward lots of ways where you could relink the pension to earnings over the long term, but maybe in any 1 year, for example, in which inflation was higher than earnings, it could go up with inflation, but then over the years ahead, it would drift back down so that over the long term, it was in line with earnings growth. So there are definitely solutions out there. The problem is the politics, and the politicians are very nervous because this policy has become so totemic. I think any politician right now is going to will find it very, very difficult to get off it.
Yeah, understandably, I think. And just finally, if I can ask you to put one of your other caps on, because you were also a multi-asset manager as well as an advisor to the former Chancellor. Just in terms of bonds and equities, how do you see the current balance of power between the two, which looks more attractive to you at the moment?
Yeah, so it's a fantastic question because it's a really fascinating moment in markets right now. Two things have happened. One is that the equities, particularly in the US, are looking increasingly expensive. We've all seen the stories around the kind of AI boom, the Magnificent Seven, all of that driving markets higher. But when you look at those sort of long-term measures of pricing in equity markets, things like the Schiller price to earnings ratio and those sort of long-term metrics that investors use to say how expensive do equities look, they look historically very, very expensive. And at the same time, the thing that we've seen over the last few years is a historic reset in yields in bond markets. So we're not, before the pandemic, we were in the sort of zero interest rate world. And, it was much less attractive to own bonds when you weren't getting those kind of high yields as part of the returns. Those two things now, the reset in yields, means that you can now get from a portfolio of high quality global bonds, you can get 6, 7, 8% yields, really with very low risk portfolio. And at the same time, when we look historically at the future returns from equities, when they have been as expensive as this, historically they've been much, much lower over the next sort of 3 to 5 years. So I think that looking right now with equities very expensive and with this reset in yields, we're now looking at a situation where over the next 3 to 5 years, it's actually highly likely that bonds will outperform equities based on the historical experience. And that's not a situation that we've been in. Particularly, I'd say the kind of added boost, as well as those high yields, is that we at PIMCO see some slowdowns coming in the global economy, particularly in the UK and the US. And that could give you an added kicker because central banks then have scope to cut rates. I think we're going to be much more dependent on central banks than we were on governments because governments have really maxed out the credit card. So any downturn, we're really going to be looking to the central banks to help support economies. And then when we have central banks are cutting rates, you get that extra capital return from owning bonds. So I think this is a historic moment in markets where it's really an attractive time to reallocate maybe away from some quite expensive equity allocations and into high quality global bonds.
Excellent stuff. Well, fantastic to have your insights. Thank you very much for being with us, Rupert.
Thank you.
Thank you again to Rupert Harrison from PIMCO for joining us. Lots of interesting thoughts in there. I was particularly struck by what he said about the bond market. Looking forward to the budget, the bond market just wants money from conventional taxes from the Chancellor in November, which is a situation which is quite difficult for the Chancellor because the Labour Party in the election campaign ruled out raising income tax, national insurance and VAT, which are the three main levers. And that makes things much more difficult for Rachel Reeves this coming November because those are the three really big levers that she can pull.
Yeah, it does feel like she's rather been boxed in a box of her own creation. We've still got
Absolutely.
Ian Aylward with us from AJ Bell. Ian, we talked about the basic features of bonds and what drives prices, but I think one question we haven't addressed is why people invest in bonds in the first place. What is it about bonds that makes them attractive?
Yes, actually, the size of the bond market really is enormous. It really does matter. It's a multiple of the total size of the equity market. So really it matters. And also companies can issue many different types of bonds. So don't just think one company, one bond, like one does with equity. There could be many bonds from any one issue. And to pick just one company, albeit one that I do know has a lot of bonds, Barclays Bank has 115 different bonds in issue this morning when I checked.
That is quite a mad figure, isn't it? That the banks just offer lots and lots of bonds to the market.
Yeah. Now, as I mentioned much earlier on, at one end of the spectrum, certain government bonds can be thought of as risk-free assets. In other words, they're investments that give you a return, usually superior to sitting on cash, with certainty. And so, Danny, what is not to like about that? A guaranteed income stream, providing the bond is held until that maturity date.
I'm sensing a but, Ian.
Indeed. As you move along the spectrum of bonds, Danny, then into the corporate bonds and beyond, but of course, the risk of default does increase, and so the potential returns can diminish. That said, nonetheless, most bonds are lower risk than holding other assets, such as equities, and so they have a very valuable role for diversification, being held alongside other asset classes. you can think of most bonds as taking one step along the risk spectrum from cash, but stopping short of the volatility or the risk of equities. The other dimension is time. It's common sense that the longer there is to the maturity date, the greater the risk of some event occurring that prompts a default. And also, I guess, due to a change in circumstance of the bondholder, the investor, our listener, if there's a risk of not being able to hold the bond until that maturity date, then you can become exposed to the price movement, and that again could be lower than the notional. That £100 I keep mentioning in the example. It doesn't end there, though. There's a really powerful additional feature, and that is the tax break. And who doesn't like an opportunity to save some tax? Capital gains tax is not payable on any CGs and any capital gains made from investing in UK government bonds. Now, to be clear, that's UK gilts held directly outside a fund, but on those, any gain in price is not subject to capital gains tax. And you don't typically see that from other asset classes.
Yeah, that's a really interesting one, I think, because that is something we've seen among our customers at AJ Bell. It's been quite popular investing in individual gilts, particularly short-dated gilts. So there's a low risk associated with them. The price doesn't move around that much. Trading at low coupons as well, so providing a low level of interest. But because of those low income payments, all of the yield is basically being delivered by capital growth. So that, as Ian says, that's exempt from capital gains tax. So it's actually quite a tax efficient way for some people to hold capital for the short term, compared to holding lots of money in cash accounts, for instance, where you potentially pay income tax of 20%, 40%, or 45%, depending on which tax band you sit in. So it's become a more popular strategy in recent times to use those individual gilts as essentially a fairly safe cash proxy, which is quite tax efficient. We're talking about outside of a SIP or an ISA here, because inside of a SIP or ISA, all income and capital gains are free anyway. So that's where people have been using them. But I think to be fair, to pick out individual gilts as an investor, you need to be pretty hands-on and pretty experienced, I would say. I think it's fair to say, Ian, most people have exposure through bond funds. They don't have the same tax advantages as individual gilts, but they are professionally managed and they are diversified. So can you maybe give us just a rundown of the types of bond funds out there, please?
Yeah, indeed. And as you say, as always with investment, it pays to diversify. And so holding a collection of these bonds via a bond fund makes sense. And actually, typically the names or the labels of these types of bond funds tends to tally with the bond categories that I spoke about earlier. So let's step through those.
That's nice. That makes things simple, Ian. We like that.
Yeah, indeed. Not always the case in the world of investments, eh? So let's step through those, starting with the lowest risk first. So very short-term maturity bonds have specific names like commercial paper or certificates of deposits. That's CDs, and they can literally have days or just weeks until maturity. And so when you gather these up together and wrap them up in a fund, place them in a fund, that fund is called a money market fund.
And just to cut in there, it's just sorry to interrupt you, but actually we've seen those being quite popular in recent times, as well as individual gilts. We've seen money market funds actually proving popular too.
Yeah. And as the name suggests, Laith, these are very short term, very similar to holding cash, but just a tiny amount of extra risk and therefore return. Next up, we have the familiar government bond funds. And as the name suggests, these simply hold government bonds of different maturities, different lifespan. They can be single country or multiple country, emerging market or developed market. They can be inflation linked or not inflation linked. So a whole smorgasbord of different types there. Next up is the corporate bonds. They again have the two flavors, investment grade and high yield. And actually sometimes you see corporate bond funds, company bond funds, where those two types are combined together. Yet again, They can be single country or multiple country. And finally, the other two most common types of funds that we should touch upon are called strategic bond funds and absolute return bond funds. Strategic bond funds simply roam amongst all the types of bonds we've spoken about already, but typically do hold the bonds long and are measured against a benchmark. Absolute return bond funds typically are benchmarked against cash, an absolute return benchmark, and use derivatives and some other sophisticated techniques that we needn't go into today. Just quickly, a word on currency. Listeners should be aware that generally speaking, bond funds are currency hedged. In other words, because bonds tend to be low risk and currency movements tend not to be, exchange rates can be quite volatile, where foreign bonds, overseas bonds are held, typically the currency exposure is hedged. It's taken away so that the currency movements don't affect the returns of bond funds. The other thing I should mention is active and passive investing when looking at bonds. As is so often the case when investing in funds, that debate does come up. And just to clarify what we're talking about here, passive investing means tracking a benchmark, an index. Active investing means trying to beat that. Now, interestingly, in actual fact, active investing in bonds can make a lot of sense. We often read about how tough it is to be active in certain equity regions, but the bond space is actually rich in active opportunities. Now, why is that, you might ask? And some of the reasons for this are it's a less transparent asset class. It's a highly fragmented asset class. The bond market is very, very diverse as well, and that makes it hard to replicate or track an index. Additionally, a lot of the participants are not seeking to make a profit. So what on earth do I mean by that? I mean that some of the players are not actually investors. Mm-hmm. They're companies or pension schemes. They might be looking to match liabilities or actually have regulatory needs like a bank or insurer to hold bonds. So
they're essentially forced to hold those bonds, irrespective of the price.
Forced buyers. And so that gives opportunities, mispricings, Laith, for active fund managers, active managers to make a profit and to take advantage of those. Also, they can, whilst distressed bonds sit in indices, sit in benchmarks, and passive funds have to hold them, active managers can avoid those types of bonds. Why invest in a fund that's got a poor outlook and is distressed? Mm-hmm. So in summary, I think it is fair to say that active investing can be very lucrative compared to passive investing. Is particularly the case in the corporate bond sector and space compared to the government bond space.
And Ian, we were talking earlier about 30-year bonds being particularly impacted and seeing those 27-year highs for the yields. And some of that is down to structural change within the pension sector because those defined benefit schemes are disappearing.
Yeah, you're absolutely right. So what we've seen historically, and this is typically a UK situation, is defined benefit pension schemes having a lot of exposure at this longer end with the longer maturity bonds to match their liabilities. But there's two things that have happened, at least two things. Those bond funds have been shutting, and there's very few, those pension funds have been shutting. There's very few of those left these days, and the pensioners are retiring, becoming older, and there's less around. And similarly, the financial position of those defined benefit pension schemes has become much, much more robust and stable. And they've been in a position where their liabilities, how much they have to pay to their members and pensioners, have been pretty much matched off by the bonds that they hold. And so, in a sentence, you're seeing the demand from a really big buyer historically of those type of bonds in the UK really dropping off. And of course, we know what happens when there's less demand for something. So the price drops and the yield starts to tick up.
Yeah. And I think that's we should. I know Ian's a multi-asset investor. He doesn't want to blow his own trumpet, but I think it's worth also mentioning multi-asset funds, which offer bond exposure too. They invest along in bonds as well as shares and cash, and sometimes other assets like property, infrastructure, and gold. And they can be quite useful for investors. Because they come in various risk profiles and the amount of equity and bond shifts around. But I think just worth mentioning those as another way that that investors get access to the bond market.
Yeah, lots of options out there for investors to choose funds which suit them. Now, we've talked a bit about bond funds, so it's probably a good time to speak to a professional bond fund manager. Alex Ralph is the fund manager of the Nedgroup Global Strategic Bond Fund, and Laith caught up with her to talk about how a professional manager picks bonds and how she sees the world at the moment. Here's what Alex had to say.
Alex, thank you for joining us today. Now, you run a bond fund. That fund can invest in government bonds in developed markets and in emerging markets. You can invest in high quality corporate bonds and also lower quality, high yielding corporate bonds. Given that you've got such a wide investment universe to choose from, how do you go about selecting which particular investments are best for you in the bond world?
Yeah, so we look at both government bonds and credit, investment grade, high yield, through the same lens, which is of valuations, technicals, and fundamentals. And we're really a value-driven fund, which means that we look at where we think the market's mispricing, whether that's this government bond market's not pricing in as many interest rates as we think is going to happen, how many interest rate cuts are going to happen, or whether we think this company is deleveraging, selling down debt a lot quicker than the market thinks, so we should invest there. So it's a really value-driven fund. But the fund is built essentially from the bottom up. So we look at credit first and look at where we think geographically, whether it's Europe, UK, or the US, because it's a global fund, is offering better value. And then which sectors, so where we are in the cycle, whether it's cyclical or defensive credit risk that's offering the best value. And then we fill the portfolio from the bottom up with particular credits, and then overlay a macro strategy on top of that. So whether we think rates in the US are going to be cut a lot quicker than the market, we will invest in US treasuries. Or if we think the UK, the market's mispricing UK government risk because of fiscal concerns, then we will invest in the UK. So we're pretty flexible and adaptable. And it's just really basically seeking where we think best value is.
Okay, so you're starting out with the corporate bonds basically, and then the government bonds kind of follow from that.
Exactly.
I mean, if we're looking at the corporate bond market, looking at high quality corporate bonds at the moment, the extra yield that the market is currently asking companies to pay above what it's asking governments to pay is actually looking very low. Now, is that a reflection of perhaps irrational exuberance about corporate balance sheets and their ability to pay back their debt? Or is it actually the flip side of that? Is it a rational fear about government balance sheets and their ability to service their debt?
Yeah, so actually I think it's kind of rational exuberance. So actually the market has been correct in pricing credit risk fairly low, purely because on the investment grade side, companies have been deleveraging and protecting their balance sheet from those period of higher interest rates we've had over the last 2 or 3 years. So actually, balance sheets are in a very good place. And on the high yield side, the index overall in the last few years has got a lot more higher quality. So a lot of the lower quality companies now finance themselves in private credit and private markets. So it's a lot more defensive in terms of the makeup. So it's rational. That doesn't mean to say we don't think it's expensive. We do actually think that credit spreads are defensive. Are expensive. We've tilted our portfolio to more defensive areas. We are investing for carry rather than spread compression. We don't think credit spreads will tighten from here. If anything, they will widen into the year end with US consumer weakening. So we are positioning the portfolio for that. But it is rational. Companies companies are more defensive now in terms of their leverage.
Yeah, I guess it's just an interesting juxtaposition, isn't it? That on the one hand, you've got companies actually looking in relatively good shape, and then I guess governments perhaps less so, which is where you'd normally expect safer loans to be made. But I mean, if you're looking kind of across your bond world at the moment, where are you finding opportunities? Where are you thinking, yes, that is an attractive investment for us and our investors?
Yeah, so it's interesting because going back to the point you're making about governments and the fiscal situation that they're seeing themselves in, we've been positioned in the short end since we launched the fund last year. We did see value in that short end. We did see rates coming down, and we did think the curve would steepen. And this curve steepening, where long end rates are rising, is a reflection of people's concerns about government balance sheets.
Yeah.
So we did see value there, and we still do. However, the long end has risen quite a significant amount to reflect that concern.
And
So
that's because people are charging the government more basically to borrow over longer time periods because there's
Exactly.
more risk essentially.
Exactly. So because the governments, quite a few Western governments almost don't seem to be able to grasp the concerns the market have over the funding of that deficit, the long end has risen. But we do think that it's risen to a point now where it's starting to look maybe a little more attractive.
Okay.
And so we have taken some of that short end positioning off, but we still have that overweight there. We've just taken that overweight a little bit down.
And when you're looking at the fund, you're running a bond fund, how active are you when you're trading the portfolio? Because with a bond, like a share, you can buy or sell it, but also you can just hold it to maturity and you get the cash back and reinvest it. Can you give us some kind of idea of, what your typical holding period is for a bond, how long you will hold the typical bond, and how much are you just leaving to mature, and then you'll reinvest it once the bond has paid you back?
Yeah, absolutely. So it's interesting times because we talked about how much company debt has performed well. Credit volatility, company bond debt volatility has collapsed. Therefore, actually, we are trading a little bit less than we normally would, purely because the bid offer spread, the expense of trading isn't worth it when volatility has collapsed so much.
Yeah.
So I'd say the average holding period on credit is probably about 6 months at the moment. And we do get new issues where the cost of trading is obviously zero because it's a new issue market. So it's extended a little bit, 6 months. We don't tend to hold them to maturity because by the time they're maturing, the spread is collapsed, and we think we can find better opportunities elsewhere. So we will tend to sell before that. Interestingly, on the government bond side, we have had much better turnover, much greater turnover, purely because the volatility's been so great. So last year it was very volatile between, the market's pricing in now 6 interest rate cuts, or the market's now pricing in 0. It was highly volatile. So duration moved around quite a bit. This year, it's been very, very volatile between geographic regions. So the US outperformed, then Germany, and then US. And so there's been a real kind of movement around geography. So yeah, the volatility in government bonds means that we have traded that quite a bit more.
Yeah, okay. And can we just maybe take a little bit of a step back and just look out at the longer term picture? You've been a bond fund manager for over 20 years now, some very kind of distinct periods, I think, for bonds within that, it's fair to say. For a good chunk of that, interest rates were really low. That's all changed now. We're back to what feels a bit more normal in terms of bond yields. Yeah. How do you see the current balance between risk and reward in the bond market now compared to perhaps with the rest of your career? I mean, how easy is it to be a bond manager now compared to when rates were almost zero?
Yeah, it's significantly better now than it was, say, 5 years ago, that's for sure. In terms of overall bond yields, it's actually still attractive. It's giving you a decent yield for the inflation out there and a decent real return. So it's definitely a good time to invest, but we think more for the income. We think it is back to the old normal. It's pre QE, before we had quantitative easing, before the global financial crisis, the markets did reflect the economics, and you were given a decent yield. And we think we're back to to that time. So yeah, it's a good time, and actually a really good time to be an active bond fund manager, purely because, as I said, the volatility within rates is giving that opportunity to outperform. We're able to move around quite quickly and nimbly between the markets, and that global nature as well gives us that opportunity to take advantage of the kind of differing fiscal situations, differing interest rate situations. So it's a good time for us. The all-in yields of the bond, even in credit, actually does compensate you, we think, enough. So even if credit spreads do widen, you're still going to get that positive total return. So yeah, a lot better than 5 years ago, that's for sure.
Yeah, okay. I thought you might say that. So can I just finally ask you about the budget? So we've got the UK budget in 2.5-ish months' time. It's obviously going to be a big centerpiece for the government. We'll probably hear about it endlessly between now and then. As a bond fund manager, how important is the budget to you? Is it something you pore over? Is there anything that the Chancellor could do or say that is going to make you buy or sell UK gilts? And I guess in particular, those fiscal rules that she has. How important for you as a bond investor is that she sticks to those?
Actually, I'd say it's very at the moment, purely because, as we talked about, the fiscal situation, not just in the UK, across, France is actually in a worse position than the UK, but it's actually made it more important as the years gone by, as the debt level has risen, then budgets actually become more and more key. So politics clearly can move the markets in the short run, and we tend to look at economics. However, as I say, going further forward, those budget rules are more and more key to how the market gains confidence in the government. So if the government did swing further to the left and decided to do kind of unfunded further spending, then that would be a significant issue for the market.
Okay.
On the flip side, if they decided they realized they had to raise taxes and therefore there'd be a knock-on impact on growth, then there is the possibility that UK government bonds would outperform. So it's interesting. You can see why she delayed the budget, just so that they can make sure they're see if they can get the right policies out there, because it is every kind of Western government is walking a more and more narrow kind of tightrope, balancing how much debt we have out there with how easily they can raise revenues.
Yeah, definitely. There's definitely some scary numbers out there in the UK and overseas as well. So fantastic. Thank you for all of that, Alex. Really great to have your insights. Thank you for joining us.
Thank you.
Thank you again to Alex Rao from Nedgroup for sharing her thoughts with us. And I thought it was very interesting what Alex was saying there about budgets becoming ever more important because government borrowing is so high, which I think tells us that bond investors are really tuned into what Rachel Reeves is going to do in November. And once again, as Rupert told us earlier, sticking to those fiscal rules, it actually really matters to the bond market. That unfortunately means that the Chancellor is going to have to find some more money, either by cutting spending or, seems more likely, by raising taxes, neither of which will be a popular measure, but is something that everyone's going to be looking forward to in that budget in November. So, Danni, perhaps a slightly ominous note to end on, I'm afraid, but I think that might be all we have time for in this episode.
Yeah, it's fascinating how much power the bond market actually has, both here in the UK and, of course, the United States as well. I mean, we've seen a lot of decisions changed because of what the bond market has to say. It's been great. A huge amount of food for thought about bonds and the bond market. Thanks so much to Ian and all of our guests on this pod. We hope you've enjoyed listening to this deep dive into the world of bonds. The main Money and Markets podcast will be back later this week, so don't forget to tune in for that. And thanks so much for listening, and bye for now.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.